Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going on out there? It's July 26th. And I'm Frank Curzio. It's the Wall Street Unplugged podcast where I break the headlines and... tell you what's really moving these markets. There's nothing really going on. Just tons of earnings. Fed meeting. Longest winning streak in the Dow Jones in 35 years. But nothing to see today. And the Fed meeting. It's like nobody cares. Barely being mentioned. At least in the mainstream financial media. Talking more about the strike in Hollywood than the Fed meeting. And by the way, is everyone strike happy or is it me? I mean, everyone. Every time I look, someone's going on strike. Not just the U.S., Canada, Europe, everybody. Strike, strike, strike. In Hollywood, it's the Writers Guild of America, Screen Actors Guild. They've come together for the first time in 60 years to strike together. And I see this because they're making much less money now that streaming has gone pretty much mainstream with all of the studios. But now, the Hollywood actors have joined these guys as well. This is after negotiations with the Alliance of Motion Picture and Television Producers broke down. The Alliance of Motion Pictures represent major studios, like the Netflix, Disney, Apple, Amazon, Warner Brothers. So it's a pretty big deal. It's been going on for a while. It could continue. Now, strikes happen all the time. We saw airlines recently, some of them signed deals. UPS just signed a deal. They were worried. Amazon, Starbucks, Trader Joe's, even the UK with thousands of doctors in England walked out, which is pretty effed up. Imagine you're operating on someone and the head doctor walks in and says, hey, you know what? Got to go on strike. I mean, do you stop operating? What do you do? I mean, if people are actually sick, you have to take care of. The doctors walked out. Every doctor in the hospital walked out. What do you do? I mean, ethically, it's pretty insane. But not surprising since money trumps everything, which we saw firsthand during COVID. Right? Trump's safety, the safety of our kids doesn't matter. Money's more important. We saw that. So much shit coming out now. It's pretty crazy. About COVID, the lies, and all BS. The suppression of doctors and leading doctors around the world. It's coming out. I don't know if it makes much difference now. See how controlled the media is. But strikes, they take place. Why? Because workers want to get paid more money and have more benefits. And the reason why they want more money is because the company they work for and its executives usually generating a shitload of money for themselves. The salaries and the benefits of all the employees pretty much stay the same. So they want a little more. You can't blame them. It's the case of airlines where profits are soaring over the past couple of years. No pun intended there. UPS is doing well. Amazon's doing well. Healthcare especially. Holy cow. Healthcare. So you can see it makes sense, and you're seeing lots of strikes. But Hollywood? I mean, what are the actors and writers thinking? If you're going to go on strike, the time to do it was a couple of years. Do it 2021. It's perfect. Stock price of every media company soared. Executives were making a fortune coming off of COVID. And investors bought into streaming as it was the next biggest trend ever behind the invention of the internet. We had Disney, Netflix, Paramount, Warner Brothers. Look at stock prices on fire. That was the time to do it. We talk about inflation. We had inflation in 2021. We're not keeping up with inflation now. But you want to strike now? When all these companies just realize that, holy shit, streaming is a really, really bad business model. It's horrible. We just realized it. Did it because of COVID. We thought it would be great, but man, that Netflix company's pretty good that can still do this. Nobody else can and make money off of it. You have lower royalty payments, which they're pissed at because the TV series and the movies that they were in, they received large royalty payments from. But now that it's moved to streaming, you don't get paid based on viewage. So now a lot of these people, even actors, and most of them aren't, The Rock and Tom Cruise and stuff like that. So they're seeing these payments go down. They're like, holy cow, it's terrible. But this was a problem for actors and writers in 2019, 2021, when streaming was growing like a weed, all the way to today where it's not just not growing, it's crushing their profits. It's maybe spending $30 billion on content a year while charging $5 a month per person is a shitty business model. Doesn't work. It's great. It's great for us. I love it. I hope they continue to do it. But outside of Netflix, nobody can really make that work. And now how are they going to make it better for everybody? They're going to make it better for you by charging you more prices and throwing ads all over it. And that's why you're going to see tens of millions of people leave Disney and all these platforms and say enough is enough. It's not worth it. I don't need 6 streaming platforms. So Netflix definitely upper hand here. Have a lot of international content, good for them. But the workers and writers are also concerned about AI taking their jobs. And look, the Alliance of Motion Picture and Television Producers came back with a pretty good deal the other day. It's a 3-year contract including a 5% increase in 1 year, 4% in the second year, and 3.5% in the third. And this is relevant to stocks. So listen up. Also includes better benefits and limits on their images to be used by AI. And the writers and the actors looked at this and said, you know what? They gave him the middle finger and said, F you, that ain't good enough. They want 10%, a 10% raise in year 1, 6.5% raise in year 2, and a 5% raise in year 3. So a 21% increase in wages over 3 years, while most media companies are seeing massive declines in sales and earnings right now. And not just massive declines, fundamental structural changes. Secular declines where people are not going to the movies as much. We're talking 160,000 writers and actors. So now Iger, right, Disney CEO, went out in the media and said the actors, writers, what they're asking for is unrealistic. They're crazy. It's unrealistic. This comes from a guy who, under his new contract for coming back, makes $1 million a year, guaranteed $2 million bonus every year, along with stock awards that could total $25 million. I agree what the actor's asking for is unrealistic. But maybe, just a suggestion here, you should have someone other than Iger or a filthy rich person at the top delivering this message. I'm just saying. It'll probably come out better from somebody else. Not from the rich guy who just came back, who was rich already and making a fortune, even though Disney, what are you doing? Selling off divisions now and trying to figure out ESPN. Holy shit, it's a disaster, laying off employees. Well, you're making a shitload of money. Anyway, it's not a good situation for anyone except for Netflix. I mean, they have tons of international content. Not going to get hurt as much. They're going to get hurt, not as much. But you look at Disney, Paramount, Warner Brothers, and some of these companies lose a fortune every year. And with the secular changes in the movie industry and ad sales, linear TV, you're just seeing a total shift. Crazy situation, massive layoffs. But if the studios cave on this deal, I mean, it's going to be horrible for them. It's going to result in even bigger losses for these companies, but even worse, and pay attention to this, guys. I've been around business all my life. It's going to result in a terrible culture because executives, employees, they're not going to like each other much, no matter what deal is signed here. Because they're not going to get the current deal with the writers and the actors want. They're not going to get that. They just can't. It's too much. Especially for companies. Again, we're not talking about airlines. We're not talking about UPS. We're not talking about companies that are they're making money hand over fist. These guys are in, trying to save themselves mode. Laying off employees, selling off divisions, that's not what you see in the media industry, and it's happening. It's real. And they haven't found a bottom yet. So now's the time to do this. And this could last for a very long time. If you own any of those companies, be careful. It's going to impact Netflix too, which is trading at a very premium valuation now after its recent run-up. So be careful with these stocks, but pretty crazy. Strikes everywhere. Nuts. Anyway, that's like the big story compared to what? Fed Day. It's the Fed Day, right? Everybody's supposed to be talking about the Fed. It's what we did. It's supposed to raise rates by 25 basis points. And I find it amazing that nobody really cares about it anymore. It's kind of like it's built in. We're used to it. The media's just focusing on Microsoft, Google, AT&T earnings, Boeing, Coke, Snap. Middle of earnings season, 25% of the S&P 500 reported. I think as of Monday, the next 2 to 3 weeks, everybody's going to report. 90% plus is probably going to be done. But the Fed used to be a pretty big deal. If we think about that for a minute, think about since March 2022 when the Fed 75% basis point hike, 75 basis point, just out of no, and everyone's saying they're not going to go further than 3%, not going to go further than 4%. Oh, they'll no way get to 5%. We're at 5%. They're still raising. It's a pretty big deal. And this is a big deal every single time. We have to hear what the Fed says. Maybe they're not going to be as hawkish. Maybe they're not going to be. You notice how nobody's even talking about it? Inflation's still well over the 2% goal set by the Fed. We're starting to see prices move higher again. Home prices are just a shade off their all-time highs. Last month was the second highest in terms of the sale price for homes on record. It's gone up for like 5 straight months after going down. Wages still growing. I don't know if you saw energy, oil's starting to fly higher, which is great. We have energy across all of our portfolios. And gasoline prices, I think I paid at least 20-25% more. 20% more? What is it? I think it was $3.05 I paid probably 3 to 4 weeks ago. It's $3.70 where I'm paying right now. I think it's $3.60 on average around the U.S. But this is just the past couple of weeks. Where do you think the CPI is going to come in at? Again, we're looking at a 2% goal set by the Fed, which is not going to be achievable, which is admittedly by almost every research firm out there, past 2024. And we're assuming, they're just going to raise like one more time. Or no, they're going to keep raising. I mean, unemployment, we're at full employment. If the Fed's going to raise, now's the time to do it because the biggest risk is inflation's coming back, which it is coming back a little bit. But with the Fed, now's the chance. Keep doing it because that big risk, which is the case study, the biggest mistake, one of the biggest mistakes ever made in Fed history, reverse course too quickly in the 80s, so inflation come back. That's what they're worried about. You want to have your name on that in the history books. But raise now that you can with the market just surging beyond belief. So nobody really cares about the Fed, but you know what? You should. You should care about this. Look, the past 6 months, we've seen maybe the bullish of the most bullish markets on record. Right, we have the NASDAQ up 35% plus, the Dow's up 12 straight days, the longest swinging streak in 35 years since 1987. If it goes up today but at close, by the time you're going to listen to this, again, I'm even with the Fed, assuming they're going to raise by 25 basis points and talk the hawkish game that we have to continue and rely, we'll decide what we're going to do based on the data we see, which is projected. Again, I'm doing this before you're probably going to see all this information. But when you look at Dow, if it closes up today, which it's kind of just flirting up and down, it's right on that line, with Microsoft being down today, but other components doing well, it's going to set the all-time record of consecutive days up. And that's going to be 13. Now, the all-time record, and I've been looking at data, and everybody's reporting this, and I hope they're right, because they're reporting it. But the Dow Jones Index was first calculated in 1896. And I don't know if they've been keeping track of the data since then, or maybe it's just the past 60, 70 years or whatever. But think about it. And even if they're wrong and it's not goes back to 18, it doesn't really matter. I mean, it's an amazing win streak. But it's happening while earnings are down 9% year over year thus far from the companies that reported, 20-25% S&P 500. It's happening when sales, the top line, it's expected to decline this quarter year over year. And it's happening when margins for the S&P 500 are going to see its 6th straight quarterly decline. That's how crazy this is. Now, throw in the fact that Mike Wilson from Morgan Stanley, the biggest bears on Wall Street, someone who was dead right in his 2022 call of the crash, very wrong in 2023, basically threw in a towel. It should be a culpa. Raises estimates on the S&P 500, said, my fault, I thought it would come down. And look, I'm not one to step on someone or whatever and just, again, just trample over them when things are down. I was bullish because, I was bearish for the first 6 months of the year because I saw what he saw. We never see multiple expansion. And multiple expansion means what? It means P ratios, companies are getting more expensive because they're going higher, but their earnings are going lower. Earnings usually drive stock prices. Throw in the fastest increase in interest rates over a 12 to 18-month period in the history of the Fed. And it's crazy to think, even with the economy sluggish all around the world, you would think like you're supposed to see multiples contract, not go higher. So he was right on a lot of the data that he said, but he's wrong on the outcome. Now, here's something that's different. Because Tom Lee was on CNBC yesterday. Tom Lee's been right, saying the market's going to go up. And they were celebrating him and like patting him on the back yesterday. Squawk Box was pretty cool. And he deserves credit. He was right when many of us were wrong, including me. Though, I thought stocks would fall sharply to start this year. But then Joe Kernan asked him what he saw that was different from everyone else. And this is where things got interesting. Because he said he knew inflation would moderate and the Fed was too aggressive on its hiking initiatives. Think about that for a minute. Because that's funny. It's actually hysterical. Because it's not the reason why stocks are going higher. Inflation is still more than double the Fed's 2% objective. And if you predicted the Fed would not raise rates at all in 2023, This would lead to a huge rally in stocks. I mean, it's crazy. And you're looking at you predicted this, right? You predicted this in December 2022. And I want you to listen to this because I pulled the clip. And this is Tom Lee. Okay. I'm going to play this for you guys. See if you could listen to it. Okay. So here it is.
Fundstrat's Tom Lee says there's an outside chance the Fed might not raise rates at all in 2023. And if that happens, stocks are going to rally in a big way.
So let's go to, I'm not cherry picking here, but let's go because they go back and forth. But I want you to get to the point, I want you to see the point where he actually goes over his forecast and why this is going to happen with the Fed. Here we go.
John, one thing to keep in mind is inflation for the last 3 months has annualized at 2% a month. If we get December, that's another month of that at 2%. And housing, as we know, is starting to soften. So, in fact, 60% of core inflation, which is housing, is softening. I actually think with the run rate for inflation into the first half of next year could be even below 2%.
Okay, so what he is saying there is there's going to be no rate. This is December. This is December that he came on, right? So in December, he said the Fed's done raising rates. And this is what his bullish call was based on. And his thesis was housing softening. Housing's not softening. It's near its all-time highs. But stocks are still going higher. So he also talks about the bond market later on, assuming that the Fed won't raise rates. A 2-year, back then was at 4.3%, assuming that they're not going to raise rates for the whole this year. That's what he was predicting. Well, it's at 4.8%. So you're right on the call with stocks going higher, but wrong on your research, where Mike Wilson was right on his research in terms of earnings coming down, but wrong on his call. I think you'd rather be right and make more money and making more money and be wrong on the actual research. But the point is when you throw all this stuff here, again, I'm not picking on these guys. Right? I'm not picking on Mike Wilson here. But there's a lot of stuff going on. When you look at the beginning of this year, everyone's expecting a market crash, first half 2023. Okay, now everyone has given up on it. This is evident from the Greed Fear Index, where the Greed Fear Index, if you look at Goldman Sachs and others like track this, but Goldman Sachs track a whole bunch of indicators, it was at extreme fear, which is a contrarian indicator, meaning that everyone's fearful that the market's going to crash and it's expected and it's priced in, it's going to go higher, and that's what happened. Now we're at the opposite. Now we're at extreme greed. We're at extreme greed. We have Mike Wilson doing a mea culpa. We have Tom Lee taking victory laps when his thesis for the reason stocks going higher was totally wrong. We have the Dow Jones up a record number of days in this market. Again, we're in an earnings recession right now. We're looking at slower growth, probably heading to a recession. Okay, leading indicators, and that number that came out earlier, like 2 weeks ago, like a week and a half ago, and that was reported like a negative 10 number. If you look back to like the 1950s and it hit that level probably like 6 or 7 times. I had a great chart of it. Like 6 or 7 times it hit that level. Every single time it resulted in a recession. This is the first time it hasn't ever resulted in a recession. But all this stuff happening at the same time, it's usually, from my experience being in this market, it's usually that we're getting pretty close to a top. I'm just saying. Because where stocks are trading, everything's trading like we're in this massive bull market, and that's fine if you thought that in 2011, 12, 13, 14, you had 0% interest rates. Free money. I mean, companies were doing whatever they want, assets, you could borrow money, you had an idea on a cocktail paper napkin, said, hey, this is a good idea. Here's $3-4 million. You can raise money easily. You can't do that. The IPO market's not frozen. A couple have come out, but you think the banking crisis is over. We look at PacWest, right? It's not. Still seeing some of the banks, the biggest banks are fine. But when you see things like this, like the reversal of a Mike Wilson call and Tom Lee taking victory laps going, hey, I was great. When the reason why you thought stocks were going high is because you thought inflation was going to come down, and it hasn't come down as fast as you thought, and the Fed's not even close to stopping raising rates. They're going to continue to raise because they're not close to the 2% target. And then you have the Dow win streak and stocks going up no matter what, and everybody giving up and nobody caring about the Fed meeting today. Nobody even caring what Powell has to say, which is basically a massive part of the markets and what's going on. Just something to think about. Something to think about. So if you're fully invested, especially in large cap tech, be careful. Because what we're seeing right now is the top 10 names are no longer together driving the markets higher. We're seeing separation among these names. From Tesla and Netflix, already reported, to Google and Microsoft reporting today. Let's break down Microsoft and Google. Before I do that, quick word from Masterworks, our sponsor, longtime partner, great people. Masterworks owns an art investing platform. Demand is absolutely surging because it gives retail investors access to some of the finest art through tokenization, a process you guys should be familiar with since we tokenize Curzio research. We can own a piece of a painting similar to shares of a stock and participate in the massive growth fine art has seen for decades. It's been at work for the last few years in the alternative space, selling $45 million in fine art in 2022, distributing the net proceeds directly to investors. So Masterworks platform can even link to tax advantage retirement accounts, or you can go the retail route and use their mobile app or website just like I do. So each of Masterworks' 13 exits so far have returned a profit to investors. That includes several sales in 2023. Looking at paintings, they can sell out very quickly on Masterworks. But right now, you can get priority access to skip the wait by going to masterworks.com and using the promo code Wall Street Unplugged. That's masterworks.com, promo code Wall Street Unplugged. Now let's get to earnings. We saw Boeing, great numbers. AT&T, I think that stock should be trading at 20. I think there's agenda against them in terms of the media going against them, environmental going against them. It's, they're reporting numbers that shows that I understand they deserve to go down. $1 billion, a little more than $1 billion in free cash flow, and they were expecting $16 billion at the end of the year. They kept that number. Now you just reported 4.2, 4.3, showing growth, growing faster than the market, and yet reported very, very solid numbers and reiterated the $16 billion in free cash flow, which I think is a given, considering $23 billion in capex that they spend every year. I mean, the amount of money they're able to generate, able to save, I think they're going to be great and in perfect condition, but nobody really cares. It's not a stock that you want in a market like this, and we stopped out. So my mea culpa on AT&T. That said, we're doing very, very great, very, very well in other areas. Lots of our stocks, again, nice weighting in oil, which is taking off right now. Small caps really, really taking off. But now you look at the main technology companies, right? Starting with Google. Probably its best quarter in over a year. And my problem with large tech and the valuations of why these things were moving higher, they were moving higher while their biggest segments were slowing. Whether it was earnings, growth with Netflix, and they added some subscribers, which is kind of shady. 5 million subscribers, but you didn't increase revenue means you got them for free, and they're probably internationally paying like 25 cents for those names. So you're seeing subscribers decline, profits decline. Netflix kind of fixed that a little bit, and you're seeing the stock go higher, which is fine. But look at Tesla. And margins for Tesla were getting crushed. Cloud for Amazon and Microsoft were slowing as a percentage of growth. iPhone sales for Apple were slowing. And then you had the slowdown ad and search for Google and being challenged by Bing now with AI. So, but yet, big problems for their biggest divisions, but these stocks were hitting all-time highs, going through the roof. But now you've seen the separation. And with Google, search, basically the biggest part of their business. And you say, well, what about cloud? You've got to throw cloud on top of that, which can't exist without a search platform. And the YouTube platform as well, throwing all that together. But this quarter was fantastic. And clear inflection point. YouTube Shorts watched over 2 billion, by 2 billion users every month, past 3-4 months, up from 1.5 billion a year ago. So big growth there. YouTube revenue, the ad revenue popped 5%. Cloud sales increased 27%. I mean, this is going to generate close to $400 billion operating income from cloud. That's a big deal because they lost $600 million from this division their last comparable quarter. That's a massive shift. Ad sales increased 3.2% overall when we're seeing overall ad sales for these platforms not doing that well, so they turned the corner. They figured it out. Seeing strong demand for its generative AI systems, which you want to see. They're controlling costs. And you're seeing Google pop, 5-6% today. And the big reason, it's not just because they turned it around, but there's a difference between these big tech companies. Google is trading at a market multiple. They're trading at a market multiple. What does that mean? It means the S&P 500 is trading about 20 times forward earnings. That's where Google is trading. Now that they're growing faster, they deserve to trade at a premium. That compares to Microsoft at 31, 32 times. Apple's up there at 32 times. NVIDIA's up there at 70 times. But NVIDIA's showing those numbers. That's fine. So you wouldn't consider that expensive, especially the growth, the guidance that they issued last quarter. But for the rest of the companies, whoa. So Google being up 6% makes a lot of sense. And Microsoft, different story. I mean, they beat strong quarter. Their guidance, little light. The stock's down almost 5%, which is why the Dow might not see its win streak go to 13, because expectations were sky high. And the stock going to the quarter, I was trading at I think it was 32, 33 times forward earnings. And I love Microsoft. I love Microsoft for this reason. I like Nike. They're one of the best at manipulating their earnings legally. Manipulating seems like a bad word, but that's what they do. They manipulate their earnings absolutely perfectly, right? Just like Nike does a great job of this. And I love it. It's someone that follows numbers. I mean, if you look at the numbers and you break down the divisions, just listen to this. It's kind of funny. So Azure Cloud expecting growth of 26-27%. Would they come in at? Guess 27%. Just a little bit better than expected. Then you go to division of productivity and business processes segment. That's Office 365, LinkedIn, Dynamics 365. Dow's expected to generate revenue of $18.1 billion. What did it generate? Why don't you guess? $18.3 million, just a little bit better. Intelligent cloud segment. Azure, I probably pronounced that wrong, but I always say Azure. SQL Server, Windows, Nuance, expecting revenues of $23.8 billion. And what did it generate? Want to guess? $24 billion, a little bit better. Personal computing segment, which is Windows, Surface, Xbox, expected revenues of $13.6 billion. And what did they report? $13.9 billion. Again, perfectly, just a little bit better than expected. I mean, we're talking about hundreds of billions of dollars, almost $100 billion of revenue with all these employees, everything coming in, and you're just able to beat by the slightest perfect amount in every single division, which, I don't know. If you're a mathematician, I'd say statistically, probably... Again, you're getting these orders in, and you could filter them in and make them longer or shorter, whatever. And this is what happens when they force companies to report every single quarter when they really don't have to. But you can push out revenue, different things, and different costs, and take charges whenever you want. But it's just so funny how when you have the best accountants, just perfect, every single segment perfectly, just a little bit better than expected. But their guidance was a little light, and they'll try to talk up AI. Who's one of the best CEOs in the world. Incredible. Thank God for Bill Gates he took over, or that stock would probably be at the $500 billion mark of where Gates left compared to $2.5 trillion, because Nadella is the one that got him into cloud. But he said they're leading the race in AI. However, on the call is a different story. The chief financial officer, she said that growth from AI will be gradual. This is a surprise because they just came out and said, hey, we're going to incorporate this in 365. It's going to be great. She said it's going to be gradual and said that the impact. So when she used the word impact, everyone on the call who was listening, that means sales. So the impact to sales won't come until the first half of 2024. Until probably after that. I mean, that's a long time from now. We have the biggest company in the world, aside from Apple, this is Microsoft, who has, hundreds of billions at its fingertips, $2.5 trillion valuation, unlimited amount of money to hire the best AI developers in the world, and they're saying that they won't see AI ramping up until a year from now? What does that say for everyone else? Everyone else who has not only talked about this trend every single chance they get during earnings calls and CNBC appearance, but what about the stock prices? I mean, you've seen stock prices go up several 100% for anyone that has anything to do with AI. And talking is a great thing. Talking is a great thing. I mean, they got Disney stock to 190 in 2021, talking about how big streaming is going to be for the company, even though you're adding, all these subscribers. Nobody cared that they weren't paying for them. These people weren't even paying anything, right? Nobody cared. But eventually, which Disney shareholders unfortunately know now, you have to follow through with the numbers, right? Eventually, you have to have those numbers. And you can say how big a trend is and how big it's great and it's awesome, holy cow. But you have to show the numbers. You have to show the growth in earnings, even in sales, not necessarily earnings, not even in margins, but you have to see sales. You have to see user growth. You have to see some kind of growth that you can monetize from in a future date. So something to think about for all the AI bulls, because, man, everyone thinks this is the greatest, biggest trend ever, but yet when you have the largest company who says we're leading this space, but we're not going to see any benefits in terms of sales from it in over a year from now, holy cow. Because these companies are so inflated in value, talk about AI, that if they're going to miss earnings, these things are not going to go down 10, 15%. They're going to go down 30% plus. You can see what happens when you miss estimates, a weak quarter, a weak growth. I mean, snap down 20%, boom, like that. Especially in a market where so many stocks are inflated. Going into earnings season, you better report decent numbers. Microsoft's numbers were not that bad. They were a little bit light on guidance, but it's a super expensive stock, And now it's getting hit by 6%. Who knows? The way this market is, it might be up 10% tomorrow. I don't know. But just something to think about if you have AI stocks in your portfolio, because that would scare me. But what are we seeing now? Getting back to this theme to finish up here. Tesla, margins got crushed. More than expected, stock got hit. Microsoft, a little bit weaker than expected guidance, which is rare for them. AI is going to take a little longer to go mainstream across all its product lines and division. Stock gets hit. Google, cheapest of the big 10 tech that's been driving the market higher. Reports great numbers, knocks it out of the park. Stock ramping higher. Meta on deck. Another company trading, believe it or not, Meta, as much as it went up, is trading at a market multiple. It's trading at 21 times forward earnings. And this is a company that's seeing growth among almost every one of its divisions. And they're either going to they're going to monetize a new Twitter platform. It's great. That's how you monetize. You take all these people off of Instagram and Facebook, create another platform. A lot of these people, again, not that many need to transfer over when you have 3 billion people on Facebook and Instagram. Just get a small percentage over. Now you have a new platform and you generate more advertising revenue. That's a growth model. Good for them. I don't know if that platform is going to be good or not. I haven't tried. I have no idea. But now you look at the cure for ads, which have come down, and the ad market is doing much better. Reels, again, Zuckerberg is the best at copying stuff and stealing shit from people and making a fortune off it. He's done it again, right, with Reels off of TikTok. TikTok is still the king. But again, that's a guy. Okay, if you look at technology companies, go back to Google, every one of these guys are scumbags. I'm sorry, they are. They just steal everything and then, go into Google's history and just all the patents that they stole and pay. It's so fun. Like, they just steal everything. And then they're like, okay, we'll pay this fine. Just, again, that's what they do, and that's fine. Gates as well. You go back. These aren't good people. However, you want to make money on their stock, and that's all we care about. We really don't care about them personally. We really don't. But getting back to the point here, Meta's on deck. Cheap, growing fast in the overall market, probably a good play. I said this a couple weeks ago. If I had to pick two, it would be Google and Meta. Let's see how Meta reports. So let's see what Amazon reports. Amazon has a lot of catching up to do. Hasn't performed like the rest of them. And let's see, dealing with strikes as well and different things. Then you have NVIDIA, which is not in the same boat as the other AI names that I mentioned because they're a hardware provider. Anyone who wants to get into it has to come to NVIDIA right now. They're king. They're king of the mountain for now. It's going to take a few years, and it's so fast development, so ever-changing. It's so hard, but you're looking at Apple, Google, a lot of companies, Microsoft, are trying to create their own chips because they have 70% margins, which is incredible in this industry that's usually commoditized, in the semiconductor industry. But NVIDIA, not in that boat because they're first in line because they're getting all the orders, they're shipping them out, and then what people do with them, they're the ones that the software part, implementing AI into your existing business, that takes a lot of time. It's going to take a lot of time. It's cool. It's amazing. It's going to change the world. But in terms of generating money for certain companies, it's going to take longer than expected. And the companies that are going to benefit the most are the largest ones where even if they're generating, if you look at this company, it generates $200-300 million in revenue. That's nothing to Apple, Microsoft, Google in sales. That's nothing, right? These guys generate $17-18 billion per division. So it's going to take a while for this to really filter through, and let's see how AI companies report, because I thought that was a big deal, getting not too much attention about the AI comments from the chief financial officer that, hey, it's going to take a little while, but that's the result of Microsoft going down, which I think was down 1%, and then after they reported, and then it opened up down 5%, 6%, because I think it's because of those AI comments. So, lot to digest there. Tomorrow we have Wall Street Unplugged Premium. Daniel and I are going to talk about the fastest growing sector in the entire market in terms of earnings and sales growth. Don't try to guess because you won't. You're going to be surprised when we talk about it. We're also going to recommend a really great under-the-radar name in this industry that's likely going to produce several 100% plus winners over the next 6 to 12 months. One of those are making their way into our Curzio Venture portfolio, small cap portfolio right now. You probably got that already if you're listening to this. It goes out today. But this new recommendation is going to go into our $1 Stock Club portfolio, which is our weekly trading product that you get for free as a Wall Street Unplugged Premium member, which is just $10 a month to subscribe. It's really cool. Get lots of compliments on it. If you're interested in subscribing, you can do that. Go to our website, CurzioResearch.com. And also, you're going to find a special discount for Curzio Venture Opportunities. Again, we just came out with a new recommendation today where the average position in this portfolio, I'm proud to say, is up over 95%. That's out of the 15 stocks in the portfolio right now. Listen, last year was not that good of a year, right? 2022 is not that good for small caps, just like it wasn't good for the markets. right now, I mean, I'm making the case with small caps. I've been making the case for the last 2 months, and you've seen small caps absolutely take off. You've seen it within our portfolio. 7 names are currently buys in the portfolio. But I'm very bullish on small caps. I mean, it makes a lot of sense in this market. They're still down 23% from the November 21 highs where everything else is surging. These companies already adjusted. We knew over a year ago that, hey, a recession could be coming. They already cut costs. They're starting to see earnings grow. You're seeing them buy back their stock. You're seeing insiders purchase the stock as well, but nobody cares. Nobody cares. Okay, nobody cares about these stocks. And that's why it's a lot of fun right now, because I'm like, wow, this stock should be trading so much higher, and it's not. And then after they report earnings a couple of times, then positive earnings for a couple of quarters, then you see Wall Street take notice, and we're already in these names, and some of them have gone up 60, 70, 80% when they're getting upgrades now from Wall Street. You don't see me talk about our products like I'm talking about this one. The reason why I am is because I think people subscribing can do very, very well. You can go on our website, CurzioResearch.com. We still have the 80% discount there. On top of that, you get a 10-minute call with me personally. You get to call personally. Again, if I gave you a bad stock, you could pay for it and yell at me during that call. But we extend the offer for another week since we're seeing really, really high demand. And look, small caps, we're starting to see the rotation from large caps into small caps right now. There is a major rotation taking place. If you notice over the past 30 days, the S&P 500 has outperformed the top 10 large cap stocks, right? So we're seeing the rotation out of that. And again, small caps are just forgotten. So I want to extend this offer because I think you guys could do really, really well. And again, Russell's still down tremendously. Not every stock in the Russell's a buy, but there's a lot of small cap names, biotech, fintech, oil, a lot of different areas I'm seeing great, great buys. But if you want to subscribe to that, going to have it for probably a couple more days, maybe through the weekend. Again, you go to CurzioResearch.com for that offer. So guys, that's it for me. Questions, comments, you can email me, Frank@CurzioResearch.com. That's Frank@CurzioResearch.com. If you're Wall Street Unplugged Premium member, I'll see you tomorrow with Daniel Creech. Take care.